All right, so after a really volatile few days, the market's trying to figure out whether this is the low or not. So I'm going to break down some patterns on charts of what we've seen previously that would suggest that the market might be trying to find a low point and offer us a good launching point going forward from here, but maybe not with the leadership that we had previously before this kind of long-term pullback that we've had. So I'm going to break all that down in today's video. What's driving this action? Which asset classes are rallying, which sectors are rallying, and what the different technical patterns are telling us, including these market forecast indicator, so that we can build our expectations going forward, which is what we try to do day after day in these videos. So let's go ahead and get started. Today is Wednesday, March the 28th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those that are watching us for the first time. I'm glad you found us. Keep coming back for more. Keep watching us. Subscribe to our YouTube channel by clicking that red subscribe button right down below the video. You can see that down here. Also, you can do that right now while you're watching. Also, click that thumbs up icon that's down there. That lets me know in one click that you want me to do this video again tomorrow, right? And keep doing it day after day. It's a really easy way to give me feedback and tell me what you're thinking there. Also tells me that you're getting something out of it. In fact, let me know what you're getting out of it by commenting down below. If you're watching this on that blog post on our blog, you can comment also down below the video at the bottom on this same page. Join our email list. If you're on the blog, a pop-up might have come up there, or you can scroll down to the bottom. There's a form. You can join our daily email, Market Outlook email list. Follow me on Twitter for more content like this throughout the day. You can see my handle up on the screen here at DavidSettle42. Like and retweet tonight's Market Outlook tweet and to share it with others, to let Twitter know you want them to keep pushing you the rest of my content. And finally, join our Market Outlook community on Facebook. You'll see the address up there. There's also a link down below in this video description on YouTube that will take you there as well. All right, let's start off taking a look at the market forecast with the S&P 500. And you can see we're still, smaller range today, but trading within the lower end of this kind of volatile period that we've been in. Almost a bullish, or excuse me, oversold cluster on the indicator. So you almost have the intermediate line in the reversal zone. Now, just go back here. We'll go back about a few years. You can see, here, let's really quickly get the, let's get these lines off. You can see the intermediate line during this bullish run. This is the period. The only other period, really, when we broke below the 200-day moving average at the end of 2015, that we had an extended, semi-extended move. And now, granted, this is a daily chart, so you've had a few weeks here, but that's about as long as we get the intermediate line below 20. You can see, on the monthly chart, that these are your two recessions on the monthly chart, and you can see the monthly chart still well up there. You take a look at the weekly chart, you can see the weekly chart never, hardly ever hasn't, since the recession, the weekly chart hasn't brought the intermediate line down. And when it does get below 50 here, and you can see there's those two times that we just talked about, and then you can see in 2011 and 2010 are the other times that we've had some really good buying opportunities. Before that, you can see 2004, this is again on the weekly chart, 2006, and then the Great Recession, you can see a few times here that we did, and you notice that neither of these highs in 2001 or this one either didn't really get up to significant moves, especially didn't get into the upper reversal zone where all the other ones did once you really started to break out of this trend. So right now we're falling on that weekly chart, and the last time we even got this low on the weekly chart was at the end of 2016, right before the election. So we're getting some movement. Needless to say, we're getting some movement here. And now go back to the daily chart, and you can see again, this is just on the daily, that outside of the recession, it just doesn't spend a lot of time in the reversal zone when it gets down here. And the last two times that it did here, well, there was one time here on the recession, right before the election, but these last two times were some pretty decent divergence patterns. So again, the first time we dipped, and then we kind of did a double dip on both of them, and bullish diverged, I guess if you could say. This one we didn't double dip. We bounced immediately right off of that on the election. And then you can see kind of right now, we did dip a smidgen below on in the early part in early February, bouncing back down there again. All right, so let's bring those back on. Just to kind of give you an idea, I mean, I showed you before that when the near-term line gets that low, we usually don't, we usually kind of bounce off of that. We could easily form another divergence here with a lower low below that, because remember the support level right now is the low point of the long lower shadow from way back here. We even talked about that back then, that that's when you get a long lower shadow, the low of that level is a support level. So we can trade within that and form a bullish divergence on the near term line, and bring that intermediate line down briefly below 20, which it doesn't happen very often, and find ourselves a little bit better of a buying opportunity here that could lead to more of an extended run. Remember, this line right here is at 20 some odd percent, 25%, 24% run on a calendar basis that you get on average when you have a January that's above 5% gain. Now, this will be the second time in history that you've had a 5+% gain in January, but finished the quarter with a negative return. Only the second time in history. 1980 was the other time. So let's go back here and take a look. We'll just look at let's look at a weekly chart here. Okay, so here's 1980. You can see the January, and you can see by February and March what happened. Here, let's go daily. And we're gonna have to zoom in. Okay, so there's your January, big rally all the way up into early February, then boom in March, by the end of March, and you can see that started a rally throughout the rest of the year that gained all the way up into the end of the year. So by the end of the year, you still had a 25% return, which is average for years, calendar years, where the January had a 5% year or higher, gain or higher. And again, this is the only time in history up until this year, and this year's technically not over. We could just jump sky high in the next couple of days and blow it out of the water. But if we stay here where we're at, this will be the second time in history, this one being the only time as of right now, that we've had that big of a January and then whammo with a loss. And then you can see again, we don't have a lot to base expectations off except for this one time, and that's what happened. And again, we also know, based off the January, every year it's been a positive year. Now, on average, it's 25%, but that's just an average. There's been years where it's barely up. There's been years it's been higher than 25, so keep that in mind. But that's kind of where we're at right now, and we're forming, we're kind of figuring out this low point here, with that low point there in acting as a significant low, and you can see we're going to be forming a new intermediate low point here right now. Whether it'll end up being a higher or a lower one, at least on an intraday basis. On a closing basis, it's got a good chance of being a lower one, especially if we get this near-term divergence. As of right now, it's slightly higher, and you can see we had a similar one over here that led to a multi-month rally. The market sentiment line is as low as it's been in the last year. Market sentiment line is actually as low as it's been since the election. So, there's pretty good odds that it's going to get below 50, which again will lead to a better buying opportunity than we've had. In fact, the best one that we've had since the election. Now, does that mean we're going to get that kind of return again? Probably not, because we had an election here. There's a lot of anticipation and expectation over fiscal policies that led a lot of this, and we're in a rising rate environment, which doesn't necessarily mean stocks have to go down. It's just going to be a headwind for stocks going forward. So it doesn't mean we'll have to get that kind of move. And in fact, we actually got below 40 there, so a little bit longer of a run. And before that, you can see if I go back even further, market the other time besides that one that the market sentiment got lower, it got down to all the way 25 here and produced that bounce that we got. And again, the multiple the bullish divergences on the intermediate line. So needless to say, we're bearish right now, but I'm not necessarily like extremely bearish here. We break below this support level, we might, again, 2550, we can trade within this 2550 area and still kind of hold within that range. If we kind of start to break through even that on a closing level, then we could be bearish for a while, right? Then we could be bearish for a while. Otherwise, we can kind of hammer around here, mess around, and find us a good launching point for the rest of this calendar year, at least into April. Remember, March and April seasonally are good months. Now, March hasn't been a good month, but that doesn't mean April's not going to be a good month just because, right? Seasonally, March and April are good months. So we'll see if we get the good month in April that you typically get this last couple of months. All right. So let's go to the next chart here. All right, so the candle here for the weekly candle, now on the weekly chart, is showing a long upper shadow. Now we're still 2 days out, right? So we can still finish, and we're flirting with that 200-day moving average again, not quite busting through it. It's kind of hard to bust through it significantly and stay down there when the gap between the 50 and 200 is so wide. It's not normal. We've traded around there before, and you can see it happened in 2014 here in October 2014. But usually the gap between the 50 and 200 have to be closer before you really break and stay below that. And remember, you've got that support here at the end of that long lower shadow that can hold things up. Now we're getting a long upper shadow. That can be bullish too, just not as bullish as the lower ones are. So keep that in mind. Long upper shadows at the end of a bearish move are bullish, not as bullish as the long lower shadows there. And we take a look at the 3 green arrow chart, and of course you've got, look how far away we are from the 30-day moving average. Here, let's take a look at the 2 lines. So here's your MACD of the 8 versus the 17, and you can see we're not really extending away from the 8-day anymore, and it's really falling and catching up, catching a lot closer up to current price. So Stochastics is oversold, bears are in control, that's a no-brainer. But you can see just how far away we are from the 30. Now we've been further away, so when we've been bearish, but we're getting about as low. Let's bring up the MACD and take a look at the 1 versus the 30. Take off these other lines for a second. And there we go. That's as far away right now as we are from the 30-day moving average. That's what that line's telling us. So we were that bearish before, and that's what sparked a rally back to the moving average. And when we rally, when we're this far up above it, we will grind towards it as it slowly comes up. You can see all these other times how we were grinding towards. There's a little bit of an anomaly there because of how far up above we were. But when you bounce up from low levels, we typically come up pretty quickly, especially from these extremely low levels. You can see, if you look over here, these other levels, we come up really quickly, up to 0 and through 0 from strong lower levels. Every one of these, none of these are grinds back to the upside. They come up pretty darn quick. So again, we'll kind of watch for that low point to develop and see the intermediate line get below and potentially the market sentiment get below 50, and then look for that to, look for that bottom to form. Looking in this area for some support on a closing basis. We can get below it on the intraday basis, maybe even form another long lower shadow, but look for that area for support on a closing basis, and then find opportunities to build into new long positions as we head and catch up to that line right there, which again is the average return for a calendar year when we've had that strong of a January. You can see it almost looks like that 1980 chart. So except for in 1980, the rally wasn't as big immediately and extended into the February, and then we pulled back throughout most of that 6-week period. It wasn't kind of a double bounce like we got here, and then the rest of 1980 was up and at them the rest of the year. You can see the 4-week low point. We're still kind of there at 258, and we've been trading within the lower end of this volatile period, and the highs at 267. Ish, the low at 258-ish, 259. So we're kind of in the lower end of this from a 20-day period. Remember, we're still very wide, and and they usually don't push down on very wides too much. We usually break down from narrow 4-week ranges and break down hard, and then bounce off of these wides and let this kind of narrow up a little bit before we push down again. All right, so right now we're still kind of in a wide range at the bottom, so we're not too bullish on here yet, right? We need, again, we can get a divergence here that's on the near-term line of what we're looking at, and you can see today's trading range smaller than we've seen the last few days. 6 points, 8 points. Okay, down the 4. Still very high, but down the 4. 146 million shares trading hands. So we'll take a look at that on the average basis. So 4 is below the average. 140 some odd million shares traded is above average, but not so extreme. So again, you want to see these lines start to come down. When you bounce off lows, they will be bigger moves, right? They'll be, just because VIX is as high as it is. In fact, if you take a look at the VIX, you can see it's not, it bounced back up, but we're not getting up to new highs. So a sign that, we might be trying to form this bottom with volatility in this area here. And then if you take a look at it on a relative basis, here we go. You can see that we're not too extreme either. Now we're bearish, right? We're above 1, and above 95 is bearish. So that 1 area is that kind of sweet spot, and we're still there. But we're not extremely bearish like we were in February, where we were just like, things were crazy on volatility. So it's been a lot more subdued, which means that, the market's trying to figure this out. And you can see, when you're at these levels, these high levels, volatility tends to drop, and see if that ends up being the case here. I did want to point out really quickly while I'm over here, when you're watching this video through the embedded here on YouTube, remember on the blog, the Market Scholars blog, you can see the tweets and the Facebook post here underneath it. You can like these while you're watching. Again, liking these clicks here, and you can share as well with these other links. But liking these tells me you want me to keep doing it. It's just a one-click feedback. Great and easy way to do that. If you're watching this on the YouTube channel itself here, then you can like it on there. Click the thumbs up that's right underneath. Remember, on YouTube you can speed up the channel, speed up the video if you want to watch this a little bit faster than what you normally do. Also, if you're not signed up for our daily Market Outlook newsletter, then make sure you sign up there, first and last name and email address, and click on that button. This will also be right below the video. So make sure you're subscribing to our newsletter. All right, now as we transition to what's driving this price action today, interesting to see, the biggest loser from an asset class standpoint. You had to look at the dollar. The dollar was your biggest gainer by the end of the day, up almost 1 full percentage point. So big move higher, even with bonds rallying too. So it's not like yields went up. Bonds rallied up higher. Stocks, you can see stocks kind of how they did. SPY, let's go from the close here on yesterday. SPY down a smidgen. Small caps pretty flat. Almost, not a lot of volatility. 0.5% gain at the best. 0.5% loss at the worst. So that's relatively tight range. And same thing with large caps. Large caps did have a kind of a bigger move intraday, but bonds up. The dollar was our biggest gainer, and you can see also developed markets, international stocks really did well and outpaced emerging markets, which fell on the day, and they struggle the most when there's a strong dollar, those emerging markets. But look at gold. We had talked about the dollar a few videos ago, and its trend and how it's been trending. You see here that today we're trying to figure out whether it's going to break out of this Bollinger Band and make a move to the downside. Well, just like that, today we bounced right back up above that middle exponential moving average with that Bollinger Band really tight. So it's kind of messing around here. It's not really, you can see how that moving average really doesn't act right now as a support or resistance. Not until you're trending one way or the other can those bands and the moving average act as support and resistance levels. So right now it's kind of fluctuating up and through it. We had a break to the downside here, but then nullified with today's close above the high of the low day of multiple days, and the impact that that had on gold, which has been trying to get above this 1400 level. Well, it failed miserably. Back to the moving average though, so we'll see, if it does that. But you can see gold's got that, it's kind of struggling to make a push up above that 1350-ish area here. Oops, not that chart, this one. So that's the dollar and that's gold. Those are your two outliers. Then, from a news perspective, here you can see that, we had GDP come out much better than expected. Now remember, a lot of this is relative to what's going on overseas. You can see exports growing after dropping the previous month on a month-over-month basis. Imports growing back up. Again, what we really care about is those year-over-year figures, which we don't get in this particular report. But the GDP number, that's the big one, being revised higher for the fourth quarter at 2.9%. Now we don't have the estimate. We don't have that tab up. The estimate's still just under 2% for the first quarter. But remember, that's a pretty decent number for seasonally what has been the weakest quarter for the last so many years. And you can see spending being revised up higher and pretty high too. Economic, from all these indicators, when you include the pending home sales and even corporate profits pulling back. So when you look at all these economic indicators, the surprise index is still holding ground, whereas globally, including the U.S., everything is negative. So remember, that includes the U.S. So that means everything else is really negative because the U.S. is really positive and keeping it around zero. So it's, everything's relative, and that's what's driving some movement into our markets, especially into our currency, at least today, when you look at it on that basis. That tech sector continues to be the one that's struggling the most during this pullback, and you can see, from that peak that we had yesterday, the intraday peak, because we rallied up till yesterday we had a high, and then we've kind of double bottom on an intraday basis here. Before still being down from yesterday's intraday high, 2.5%. But look, it's your discretionary and your technology that are bringing it down the most. Remember, those are the biggest movers. They have the biggest moves again. In fact, something I tweeted out earlier today, if you follow me on Twitter here, something I tweeted out was, this is the monthly chart for QQQ. And you can see it's got a little bit of a evening star candlestick pattern, very bearish. 1 month after getting a bearish cluster, which on that particular month here we had a bearish cluster on QQQ. We don't get those too often, or an overbought cluster. I kind of run out of gas usually when you get those kind of moves. We didn't get it on that one. You can see the momentum line didn't rally until the next month. But a long lower shadow, not as bearish as long upper shadows are, but we haven't had a long upper shadow that long. As you can see, it's not very big compared to some of these long lower shadows we see, but you don't get long. I mean, look at all this. In fact, the last time we had one that big at the end, and this far away from moving averages, was in March of 2000. Now, that's obviously a little bit of a clickbait there, I guess you could say, because that ends up being the peak in that particular bull market, and whether this ends up being the peak and we start a recession here remains to be seen, right? Especially with everything we've talked about before. But needless to say, we've had a really good bullish run, and that's a bearish sign that would suggest that technology is not going to be nearly as bullish going forward, and you might start looking for leadership in other areas. And we've talked about, usually maturing bull markets show leadership in the energy and material sectors when those commodity prices kind of hit extremes. You also, have some opportunities we've talked about with utilities and, whoops, that's the wrong chart. With utilities, hit the wrong button there. With utilities and real estate. And you can see since the market peaked and lost 2.5% on a broad basis, real estate's up 1.75%. Utilities is up 0.75%. Staples is up. And remember, those have the biggest gain. They have the biggest room to rally because they've been down and have been held down for so long. While these other sectors like technology and consumer discretionary have been so bullish, well, Now the market's rotating out of these really bullish areas, high momentum areas, and rotating into some cheaper areas. And these momentum and energy plays, there are going to be opportunities there too for them to gather some leadership. They had some leadership previously, but not any more than what we know some of these other sectors. But once you start to see them gain while these other sectors stay down or match the market lower, then okay, this long-term bullish cycle we've been in may start to be showing some signs of maturity to the point where we might get more of an extended bearish run than the sharp declines we've been getting over such short periods of time. All right, so as bearish as today was, one stock here in that consumer staples area that showed a pretty good bullish day is this Colgate-Palmolive. Now you can see it's got earnings coming up, and so we do have to keep an eye, and it's had bearish responses to earnings before. In fact, all four had some declines, but didn't hold. I mean, here's the only time that ever had a bearish decline and held was in January. All these others rallied off of these. At least here it rallied intraday, and then rallied off of these low points. So you can see that with earnings coming up, and you got April 20th is when these options expire. You can see that the earnings is on April the 27th. So we can get out of these spreads. Now, the volatility might not help us because volatility will probably stay higher, move it a little bit higher throughout this period as we take a look at some options trades potentially to make on this. But it's got a good technical picture, a good little breakout. You can see from a 3 green arrow standpoint, and the short-term sentiment was improving to a good with the intermediate line rising. You can see from a 3 green arrow standpoint, look at that big old divergence developing and crossing over on both these lines. And then you can see from a Bollinger Band perspective, not getting up above the upper band, but breaking up through the middle and looking for some resistance in here. So we can say, okay, well, what if we just did a very short term, because it's only got 23 days left, short-term high probability trade. You can see I still get pretty decent credit, that 30% return on risk for the spread I'm looking at $2 wide on this. I can get into that, and you can see based on that, that's where my expiration date, that's where my break-even point will be. So it kind of has to nullify this little breakout that we had today and get back below these candles. The odds are pretty high that we'll stay above 69. 68.5 is where the crossover point is, where you're going to get a loss on whatever day it is. That's going to be about the same as we're going to get, as a gain as we're going to get. We'll take a look at the chart. 68.5 is right about there. So again, you can see that there's some support in this area at that line. If we were to break through that support, then we'll take that small loss, or a little bit smaller or bigger, and get out of this trade and look for something else. So kind of taking advantage of some potential outperformance in these safer haven area sectors as we rotate out of the more aggressive sectors, higher beta, higher momentum sectors like technology and consumer discretionary, especially lately. Looking for something in here that's showing a good technical pattern on the day in the last couple of days that haven't been so good for the broader market as a whole, especially for those high-flying QQQs stocks like Facebook and Netflix and Twitter and things like that. So that wraps us up for today. Thank you very much, as always, for watching. It's been a crazy day, and there might still be a little bit more, maybe not so extreme, but we might still trade within that long lower shadow range. So there might be some more downside there before we get the intermediate line and the market sentiment line at points where we can get a decent launch point. And we establish by the end of this quarter, we establish this kind of pattern, bullish, really bullish January, followed by a bearish move for a negative quarter. That's only ever happened on the S&P one other time in history. We'll see if we repeat the next 3 quarters of what happened in that particular year going forward this year. And the trend, seasonality at least, would favor more of a bullish move off of these low points we're trying to develop here. So Thanks again, everyone. Have a great evening. If we do bounce, it might not be the technology and discretionary as we see, the rotation, and that's where today's trade idea came from. So again, thanks for watching. I appreciate the time that you spend watching these videos day after day. Let me know if you want me to keep doing them by liking the tweet or the Facebook post or both below. And also, if you're watching this on the YouTube channel, click that thumbs up. That lets me know you want me to keep doing these videos day after day, me and Brandon and I. So go ahead and let me know there, and we'll see you all tomorrow. We'll see what the market does here with the short-term moves we're seeing, and what we'll do, as always, what we'll do about it going forward from there. Have a great one, everybody, and we'll see you all next time.